Silver is trading at 75.5, exactly where the roadmap projected it would move if support held. On the daily chart, the February 6th candle was identified as the anchor. The 72.6 to 70 zone was defined as key support. The swing failure pattern was clear. The condition was simple. If price held that range and we saw a displacement, upside targets at 75 and then 77 were in play. Price held. Displacement followed. Now we're here. This is where discipline matters most, not emotion. Western silver spot sits at 75. Futures trade at 75. Shanghai spot is 86. Futures 88. That's an $11 east to west premium. Gold is at 4,130 in the west. At 2 p.m. Eastern, the FOMC minutes are released. High impact event. Expect volatility inside that window. The economic calendar doesn't predict direction. It tells you when liquidity events are likely. For tape readers, that matters. Here are the levels. On lower time frames, structure remains constructive. Upside objectives sit at 77, then 78.2. If buying pressure continues, those are the magnets. Immediate downside support sits between 74.8 and 73.9. Wicks into that zone are acceptable. That's liquidity testing. What is not acceptable are body closes below 73.9. Bodies closing beneath that level would signal weakness and suggest the bounce is failing. The February 6th candle remains the anchor. We do not want to see body closures near the proximity of its wick. Touching it is fine. Closing into it signals deterioration. If we get sustained body closes below the 72.6 to 70 support zone, then the downside opens towards 67, potentially even below the February 6th wick. That remains the invalidation structure. With FOMC minutes today, this is not a guessing environment. It's a reaction environment. Let the market respond to the news. Watch volume. Watch how price behaves around the defined levels. Confirmation first, position second. Now, here's what shifted overnight. The United States developed a critical minerals price floor system and is pitching it to allies to reduce dependence on China for strategically vital resources. Multiple agencies reportedly constructed a sophisticated floor pricing mechanism. Officials confirm active discussions with partners. Pricing, according to official statements, is the lever needed to unlock private investment. On the headline, gold surged roughly $90 to $4,156. Silver jumped over $3 to $75. This is not just a price spike, it's a structural development. A government-backed price floor for critical minerals, including silver, implies minimum pricing support regardless of paper market pressure. When sovereign governments guarantee floor prices for strategic commodities, the traditional paper mechanism of suppressing prices below production cost becomes significantly less effective. For years, futures markets could drive price beneath cost structures, forcing marginal producers out and reinforcing scarcity narratives. A price floor alters that equation. Ray Dalio recently warned that escalating trade tensions and expanding fiscal deficits could undermine confidence in U.S. debt, potentially driving investors toward hard assets like gold, which he now frames as essential, not optional. Dalio's debt cycle framework has always centered on currency debasement and long-term capital shifts. When institutional capital at that scale reclassifies gold as essential, it signals structural repositioning, not tactical speculation. Now look at COMEX. Registered silver has fallen to 92.2 million ounces. March open interest stands at 285.3 million ounces. And that's roughly 193 million ounces more paper than registered metal. Last Friday alone, nearly 5 million ounces were withdrawn from COMEX vaults, with 800,000 ounces shifted from registered to eligible. Registered now sits near 92 million available to settle futures. Withdrawals are accelerating. The roll mechanics tell the story. March open interest declined only 7.6 million ounces, from 293.9 million to 285.3 million. At this stage in the cycle, the roll should be accelerating aggressively. To normalize positioning before settlement, open interest would need to decline roughly 30 million ounces per day. That pace is not occurring. The curve tightens daily. The March to May spread is negative 52. After financing, storage, and insurance, the carry-adjusted contango is only 4.9. The market is paying almost nothing to incentivize rolling forward. If there is no economic incentive to roll, pressure concentrates in the front month. Upward stress on the March contract builds every day that the roll lags. 8 days remain before March settlement begins. The data is public. CME publishes it daily. Everything points in the same direction. Price likely needs to move higher to rebalance this structure. Now shift to the producers. Hecla Mining reported revenue exceeding $1.4 billion, up 53% year over year. Net income reached $321.2 million, a ninefold increase. Silver production totaled 17 million ounces at the high end of guidance. Debt was reduced 50% to $276 million, with net debt down to $34 million. All operations generated positive free cash flow. This is what occurs when silver prices reflect supply-demand fundamentals instead of sustained suppression. Companies that were marginal at artificially low prices suddenly generate record profitability when pricing normalizes. Jim Rickards wrote in Currency Wars that commodities become weaponized during geopolitical realignment. Nations secure supply chains, not for profit maximization, but for strategic independence. A U.S. critical minerals price floor fits that framework precisely. This is not classical free market behavior. It is strategic policy. When dependence on adversarial powers becomes unacceptable, governments guarantee supply through pricing mechanisms. The shift was inevitable once U.S.-China decoupling accelerated. Now layer in geopolitics. Reports indicate the U.S. moved closer to potential large-scale conflict with Iran. Officials suggest that if military action begins, it would not be limited but could extend for weeks. Diplomacy continues, but significant gaps remain. Military assets are building across the Middle East. 20% of global oil flows through the Strait of Hormuz. A prolonged conflict there doesn't just raise oil prices. It disrupts manufacturing supply chains dependent on Middle Eastern energy. Industrial silver demand is already in its 6th consecutive year of structural deficit. Meanwhile, mining stocks represent just 1% of global equities. From 1900 to 1965, mining averaged 8%. Between 1955 and 1965, it approached 10%. To return merely to historical average weighting, mining shares would need to rise 8-fold relative to global equities. To reach historical peaks, 10-fold. Governments are reshoring manufacturing, rebuilding supply chains, prioritizing energy security. None of that occurs without metals. Mining and energy transition from cyclical trades to strategic sectors. Capital allocation shifts from margin optimization to supply assurance. Charles Mackay documented how markets oscillate between extreme pessimism and extreme euphoria. Mining at 1% of global equities while governments implement price floors for critical minerals reflects a pessimism extreme, precisely as fundamentals begin shifting toward a multi-year bull structure. Gold miners versus the S&P are approaching a breakout from a decade-long range. In 2011, that ratio was 3 times higher than current levels. This cycle differs from prior ones. Central banks are persistent net buyers. Confidence in sovereign debt and fiat currencies continues to erode. Analysts compare the setup to the 1970s, when miners dramatically outperformed as inflation and currency debasement redirected capital into hard assets. Now consider the bearish case. FOMC minutes. Today could introduce volatility that breaks technical support. Iran tensions could de-escalate, removing geopolitical premium. The critical minerals price floor remains in discussion phase, not yet implemented. March open interest could accelerate rolling in the final week, as has occurred historically. Registered silver at 92 million ounces is technically sufficient if the historical 5% delivery rate holds. Mining's underweight could persist if institutional capital continues flowing toward technology and AI rather than commodities. These are real counterpoints. They must be acknowledged. But the broader data picture shows a U.S. strategic price floor initiative for critical minerals, COMEX, registered at 92.2 million versus 285 million open interest. Roll pace insufficient relative to settlement timeline. Carry adjusted contango at only 4.9. Producer profitability expanding sharply. Mining equities at historic underweight. Escalating geopolitical risk in a region controlling 20% of global oil supply. Institutional voices reframing hard assets as essential hedges. And technically, silver held 72.6 to 70, exactly as mapped, then advanced to 75.5. Here's what matters. The technical framework is functioning. That gives traders structure amid volatility. The COMEX imbalance is intensifying, not resolving. Strategic commodity policy is shifting at the sovereign level. Geopolitical risk remains elevated. Mining remains historically underowned. FOMC minutes at 2 p.m. provide the next catalyst. Price is information, but not always truthful information in the short term. When paper markets suppress commodities below production cost for extended periods, eventual corrections do not unfold gradually. They occur abruptly when physical constraints override financial engineering. Those positioned early understand that structural shifts are rarely recognized in real time by the majority. Operate on data. Operate on structure. Let the market confirm the next move.